favorite financial podcast, The Lens, with Larry McDonough. This week we have another special guest tailored just for you. Larry's killing it with introductions this week, so here we go with Ben Bray. He's one of Larry's old friends and contributor to the Bear Traps Report. He's the managing partner at Convex Solution, and today he's gonna join us. We're gonna talk about rates, Fed, oil, the macro picture of the whole economy, and how the recession probability is rising due to the financial conditions. We have been talking about this on our reports, the turning point. We have been talking about it on the Bloomberg chat that you're going to see behind Larry's screen. So, guys, go ahead and let me know what's in your mind.
Thank you, Valentina. Thank you. Happy birthday, Jose, and the team in New York. Great job putting this together. Ben Bry's in the house. Good to see you, my friend.
What's up, buddy?
Yeah, so we called this the Four Horsemen because I love that. But one of the things that we run the Bloomberg chat behind us with hedge funds, mutual funds, and pension funds. Ben's been in the chat for probably almost a decade now. Ben, one of the discussions in the chat is the financial conditions tightening at a very fast rate of change. In other words, even though the Fed's not hiking, there's a lot of hiking that's actually taking place through financial conditions. You want to kick it off with that thinking?
Yeah, we can get that going. I mean, the idea, it's so funny because we go back to '08, right? And people think, oil price was independent somehow of what happened when, you had your experience at Lehman so long ago. And I have this theory that energy is primary money. So primary money rips higher and, it's rate of change because people will say, we had $100 oil in the shale boom post GFC and, the economy is okay. You get a spike like that. It's basically like taking rates up 500 bips, 700 bips. I don't know the exact number that we'd say, but it's like tightening everything. And then,
like a big tax increase, right?
Yeah, it's literally kind of funny because I was one of the people who argued very adamantly that that the tariffs would be deflationary, whereas everybody and their mother, the talking heads on, they're saying, it's going to be this big inflationary thing. Well, the reality is money and credit growth are where inflation comes from at the end of the day. And, basically, if you don't have that, well, then it's just a tax. And so right now, oil, we have the same dynamic where, I know what you think, but it doesn't seem like the credit market's very good. And, so you're just seeing a situation where this is just going to amplify all the underlying situation. We can get into them more.
Now, this chart, walk us through it because it's a very thoughtful chart, but it's not well marked. So you really have to explain what we're looking at here.
Yeah. Sorry. I sent that over to Larry last minute.
No problem.
But this is, just to go back to the '08 analog, is we had the oil spike, which is in the blue line right there, right?
So the blue line's the oil, okay.
Yep, and then the candle chart is the Eurodollar future '09, which now would be the SOFR future '07.
So to simplify that, that's rate, it's expectations of what's going to happen with rate hikes.
Yeah,
or rate cuts.
It's like 3 month forward rates on the curve. So it's think about it like policy rates expectation curve. Fed funds futures is a more pure version of it, but it's the same kind of thing. And so what you're seeing now is we've had 50, 60 basis points and even more in Europe of rates. The rate curve have completely gone the other way, right? We see this huge bear flattener. You've seen policy rate expectations go from expectations of cuts to now, these crazy bastards are now talking about hiking, which is absurd. But what you saw is you see that candle chart where we were about the same level, 97, in, call it the spring around Bear Stearns, the spring of '08. And then you had this oil price shock and people try to think, it's inflationary and all this stuff. And, it was just a counter trend rally or counter trend sell off.
And Ben, in the 80s and 90s, we would have recessions all the time that were just driven by oil prices going up, right? In other words, it caused these contractions in the economy. based off of oil prices going up. That's what usually brought on recessions in the 80s.
Yeah, I think that's right. I mean, I think the 70s, 80s, the Suez Canal thing, like I think the hit rate's almost 100%. Oil price shock leads to recession. And it makes sense. Like I said, if you think about it as primary money and like most important commodity besides maybe water in the world, it filters through the plastics, it filters through all kinds of stuff. Well, it crushes margins, and it just squeezes everything, squeezes liquidity, squeezes the economy.
So here we noticed Buffett was buying the builders in the third, fourth quarter. Lennar's now down almost 40% off the highs. But what's interesting is you don't see a lot of financial conditions tightness in Citi. But there is some real lot of pain in the builders. There's a lot of pain in some of the other financials, like the BDCs. So we're seeing financial conditions tightening, but it's having like different impacts in different parts of the market.
Yeah, I mean, look, I was the idiot who was short the big banks last year, and I was short the Blue Owl at least a little bit, but like the real trade in financials was down in the BDCs and the private equity shops and that stuff, and even that that Lennar is not a great chart either. But I think that right now we're seeing the banks who there was so much exuberance for them, right? There were regulatory relief. And, basically all these things, they were going to have great capital markets. And my buddy Charlie Peabody had talked about it. And then it was around January, things started to turn a bit. And, we've now had, I think the financials are down, XLF's down to 10% year to date, something like that.
Well, yeah, it's 14% off the highs on the XLF, yeah.
Okay, but down year to date, though, it's down 10. Okay, yeah. So you got a decent correction, right? So consumer and financials are the worst two sectors right now. And I mean, like, there's enough people that have talked about this in depth on Substack and other things where you could go see, but there's a lot of exposure for these banks to this private credit. But it's like, I don't know. I mean, rates going to go down isn't good for them either. So, that's a loss of income for these
on
guys.
The private credit, Ben, like they either lied to us. So I'm talking about the sell side, right? The research. They were calling private credit idiosyncratic. The word idiosyncratic was literally used across sell side research hundreds of times in the fourth quarter and the third quarter. So were they either lying or they were naive? Because now what I noticed when the rate of change of information around private credit, in other words, you're getting more truth, you're getting more gates. Now all of a sudden you got a revolutionary in there from UBS that's calling for a default spike, right? So he's kind of leaving the crowd, right? But so my point to you is, Ben, doesn't it remind you of 2007-8 where subprimes contain,
Yeah.
and then all of a sudden it's not as bad as the way, but I just mean is the way the truth changes all of a sudden slowly and then fast.
Yeah, and so like you got to remember the liability structure in 07-08 where the banks had it all funded. I mean, like you guys were funding with wholesale markets, Eurodollars, and then had that all cross collateralized. And so it's not that, right? Because the liability structure is definitely stronger. So, it's maybe that's why this is such a slow bleed too, right? Like the people been so conditioned to contagions or these spike down. But like right now, look at the market. It's like every day you just wake up and get punched in the face basically, and you don't die, but it hurts, right? And so like down 40 bips, down 70 bips. Today, I think we're down 1%. But like there's just been no bid. Like yesterday we saw the excitement about when Netanyahu came on and they're like, oh, they're trying to off-ramp it, and ripped it 100 points. I woke up, boom, down again, reverse.
So on this chart, here's a thesis that I'm hearing from clients this week that's coming in where because of the move in energy, because of the move in financial conditions tightening, the probability recession is spiking very fast, but there's a natural reaction to 2 years because of oil, right? And you can see there whenever you see the 2-year treasury go through the Fed funds, which is pretty unusual, right? It's a sign the market's really getting offside. I'm hearing guys starting to think twos yield is capped around here. Something like today might be the high, because at the end of the day, you've got incoming stress from oil prices going up on the consumer. You've got financial conditions tightening. You've got this private credit meltdown that's clearly getting worse, leaking over to high yield. And so all those things combined, then you have job losses from AI, right? So all those things combined probably are creating potentially here a cap and choose. So people, that's why I'm starting to see guys look at the builders, look at Rocket Mortgage. Those are some of the new themes that I've seen this week. What do you think?
Yeah, and that's what I like. I mean, Larry, I've been a bond bull for a long time. It's been a rough month for the bond bulls. Like sometimes you got to take it in the chin. But again, go back to what I said in the beginning is like, yeah, it's reacting to oil. And I also think, Larry, that there was a lot of guys who had the 210 steepener on or, 230 steepener on or whatever. And, some of the action we've seen feels like levered player getting taken out, capitulation type of stuff. And so I think there's the unwind of that. And then I think there's the oil response. But like, I'm totally with you. Like, we talked about the four horsemen. You got credit, the dollar, oil, volatility, and to, I guess, the fifth would be rates, all going against you right now. And
so walk us through the four horsemen. Credit. Well,
so credit, right? So we've seen credit spreads rising. I own a bunch of credit default swaps on the high yield. And, we've gone from 290 at the beginning of the year in HY45 to now 370 and change. IG's kind of come up. There's been a lot of issuance, actually. And maybe that's a sign of, hey, if you need to issue, maybe now's the time to do it before things clam up. Then you have basically oil, which is a huge one, as we talked about on the show. You have the dollar, the dollar wrecking ball, because 2/3 of global debt is denominated in dollar. And that's why you get this dollar rally whenever there's deleveraging, and that just runs things over. And then you have volatility, both in rates. The move index is probably what's quoted the most. And then I trade vol, so I don't think about vol in terms of the VIX, but like for most people, like they look at that's like at the money 50 delta S&P vol. And it's elevated, right? We're in this 25 to 32 range. And I tell you, that's actually a problem, because that comes back to the whole getting punched in the face thing, is like, it's high so that, today's OPEX, right? A lot of people have been, the market's been well hedged, I think. Well, those hedges wear off. Now you got to roll, like, maybe they've been rolling off, but you're rolling off at a much higher price, but it's not so high like, what happened on Liberation Day or, COVID, where you can create a synthetic demand where guys can sell puts and lock in, like an 80 vol, you can lock in 30% plus yield of buying it, or you buy the asset down 20%. A lot of guys will do that. Whereas here, it's kind of like, yeah, you could make a little money selling it, but it's dangerous. And it's also like hard to buy equity vol. So it then is enough where the deleveraging happens, where, a lot of risk models will use that as their, how much leverage can we put on? So that's there. So you need to see some of these things as barometers of, they're all going against you. Whereas like last year, post Liberation Day, and I talked about this a lot, there was volatility suppression, oil suppression, dollar suppression, credit spread suppression. And so while I would say, yeah, maybe the AI thing was like a real thing to be excited about, I think most of that rally was just the driver of those four things going the other way. And now it's the opposite, and now rates also. So it's just a lot for the market to handle when the five major mechanics like are going the opposite way of risk assets.
Right. So we got twos here versus Fed funds. Obviously the red on that left side is the hiking cycle from the previous hiking cycle where they took Fed funds way up, right? And so you can see now we just kind of crossed that level. Jose, let's move the slides. We don't want to get behind here. So next one, so twos, tens, big move the last 24 hours. And this is what I think some guys that had the steepener on got carted out this week.
Carted out. I mean, you can see it. Look at that chart. You see that those candles where they just wick down and then they got bid up. That's like some capitulation type of moves where guys are like, no mas, and they got tapped on the shoulder and they're told that this is time for you to get out of that, buddy. Because remember, when you trade this stuff, when you trade SOFRs, you use a lot of leverage.
Oh yeah.
And so really fast move like this, you try and be again, I own the SOFR Z7s. And so it's been a painful, we have the credit spreads offsetting it, which often they move together, but right now they're moving opposite. So there's a little bit of a hedge, but like this is a very painful thing. So question is like, do you really believe that prices, like if jet price or airline prices and prices of fertilizer and prices of gas and all that stuff go up, do you think that it can be passed on? Like that's where your question is. And that will come back to, Larry, then the labor market, which I think, the last jobs report wasn't good. We've had a ton of downward revisions. So in essence, the job reports were kind of BS, last year. And so I think the labor situation is not good. And I'm involved with an AI company. And so I'm like kind of on the front line seeing what can be done with these AI agents. And let me tell you something, that's one of the reasons why you're seeing.
Walk us through the agentics versus, LLMs.
Predictive.
Like LLMs are like just like a Google search versus real agentics, right?
Yeah. So, I was kind of on the initially, a long time ago, I built a neural network trading strategy when I was in grad school. So I've understood this for a long time. It's just like a linear regressive model that predicts the next token. There's no like intelligence here. So like, I was like, okay, on the predictive stuff, I was like, look, this is better search, right? This is better than just doing a Google search. But now there's been massive improvements in, these basically agentic AIs, whether it's OpenClaw for Claude, or now the Perplexity computer came out and you can use it. And honestly, I would encourage everyone to go toy around with it. And this amount of stuff you can do once you learn how to talk to this thing like a toddler and how to constrain it and then how to reiterate is, a lot of people who are graphic designers, junior lawyers,
so
guys.
Give me a number. Total job losses by September, a couple 100,000.
Yeah, I think so. I think there's actually a website that was spun up that's got the number of jobs, attributed to AI. You never really know, because the other argument would be, hey, they overhired, a lot of these tech guys overhired post-pandemic, and they didn't want to lose the talent. So there was a competitive aspect to keeping people in-house. So they were maybe running bloated. So you don't really know. Some of it's like, hey, maybe I want to do, instead of an AI, or do an actual Indian, and they move it over to India, right? And so you never exactly know, but I'm just telling you that this is the early days, and just seeing what these things can do. I just feel like there's a lot of people in the middle curve of the services economy that have really, like 45,000 jobs at Oracle, those aren't chump jobs, right? Those are jobs with stock comp and six figures, and it's not like losing McDonald's jobs or seasonal retail jobs.
Right. And so here on the semis, everyone's crowded into the semi trade. It's been one of the safer parts of the market. But one of the clients mentioned, weekly MACD roll there, chop the lower right hand side. That's pretty bearish. And then you have kind of a fail here to get back up in that bull channel. A lot of people are crowding in here, into semiconductors, because that's been one of the safest parts of the market. But we'll get into the further in the presentation. It's very clear that the natural gas names and the coal names are destroying the Mag 7 this year. Everyone's in the semi trade, which is yesterday's trade. Nobody's in the energy trade.
Yeah, I think basically, if you think about the re-rating in software and crypto from what's like October 9th, or until I don't know, recently, and I was saying to people, I was like, I bought the IGV for a trade on the bounce and then started shorting the SMH. Because I think what happened was a lot of guys got pushed out of that software and, crypto related stuff, and they didn't know where to go. And I think it just added to the crowdedness of the semi trade, or the CapEx beneficiaries like the Vertivs of the world, or Comfort Systems as HVAC, whatever, right? And so now I think you're in a position where this is a crowded trade, and I don't know if people really fully understand how the architecture changes coming, like in compression. Well, because right now everybody's like, I'm telling you guys, go use an agent. So Larry gets on there and he's just blowing tokens, and it's good to do that because you're just trying to figure it out. But the next stage of this is going to be actually, I don't want to get too deep into it, but basically compression of architecture, compression of intelligence, of how you ask it, how you harness it. And never short engineers, right? So that is going to be leading to like a compute surplus, I think, on the horizon. I had my partner. Go ahead.
It's interesting that this growth versus value here, it's very similar to 2022, where we had the big move in commodities. We had kind of a rate shock in 22. We had a war, and we're seeing the exact same price action here, whereas growth is underperforming value by an accelerating amount of late.
I mean, yeah, I think that's probably similar. I mean, I think we had Mike Green on my podcast recently, and he talked about he talks about passive all the time, and he said that basically the .com was passive 1.0, and then this is 2.0, and then people were so overweight the tech that it wasn't even like just getting less weighted on that. Then they had to bid this other stuff up. So it wasn't like, oh man, I loved value. It was like they just own none of it because they own way too much tech. And maybe the argument now would be they own too much semis, they own too much Mag 7 or whatever. But to be fair, I mean, some of this stuff has started to come off, right? Like Microsoft and the software names. And so, we started to see that. And I think in fact, I mean, look, you were more in the game than I was. I was a young grad student. The most speculative stuff rolled first, right? Like in 2000. And so it was a wave of that experience, right? Like there, and then you took the junior growth guys out, and then finally it took to 02 for the market to finally, because the S&P held up relatively okay during that period till the very end. And so you just want, and right now it's holding up okay, right? Even though it's like been weak lately. I mean, we're still at 1,800 points higher than liberation lows last year, right? So people don't like to have markets go down, but like at the same time,
and look at the strength in natural gas names, OKE, One Oak, Range Resources. We see a lot of clients moving back into natural gas names for the AI trade. Plus the energy space is just so underowned. $4 trillion is left the NASDAQ 100 in the last couple of months, and that money's definitely coming into energy equities. Next one, Jose.
Yeah, I mean, just as we're waiting for the next chart, I mean, I think LNG names have done really well too, right? As the Qatar supply came off, you look at a Next Decade or Venture Global, which was an IPO out of Goldman a year ago, and those things are going vertical. Cheniere's done quite well. Yeah, it's been energy guys were kind of it's just they're like a redhead stepchild there for a little bit. They're having the moment.
Yeah, and here you have the FCG, which in the natural gas equities, just absolutely destroying Mag 7, destroying the S&P this year, but you're right, it was dead money in that third, fourth quarter, and it put a lot of people to sleep. And now you're seeing that big rotation out of tech into value here, into natural gas equities that are going to be the backbone for artificial intelligence. Let's keep those moving fast, Jose. Thanks. And then here we have the coal names. So we've been aggressive buyers in the trade alerts. Ben, you get our trade alerts on WhatsApp, info@thebeartrapsreport.com to join us. But we've been heavily positioning clients in the coal names, in the natural gas names. We just lightened up a little bit, so we're back to 2/3 on CNR. But free cash flow yields of 10% in the coal space. And once again, LNG in the Middle East, 20% is locked down. That gives you pricing power for coal globally. And here we go. Microsoft unchanged since the second quarter of 2024, almost 2 years. I think third quarter. So we're going on 2 years in November. Microsoft unchanged now. And look at the underperformance of Microsoft versus the S&P. What's going on here, Ben?
I think it was the it started, it's funny actually. I think that though in September, you remember the bonkersness of like everybody's putting out PR notes of, hey, we're going to do this deal and we're going to do this circular funding deal, and the CapEx was all being rewarded. Well, I think that stopped in the fall, started with Meta and then it kind of moved out. And you've seen, I mean, Apple's outperformed actually, and they decided we'll just wait and see on this. I got to tell you, I think the software names in general have gotten re-rated, and Microsoft is a software name, and even though it's the biggest and baddest of all of them, I don't think it was in any way. Because what I'm seeing is instead of having this huge firm for software, it's now possible to have these smaller flat firms that then can take advantage of these agentic AI things that can then take share and run wildly more profitable operations. But it's not like really adding much to the economy. It's just like the guys who are doing it, which is why I'm involved with one, are making a lot more money. Like it's a wildly profitable opportunity for those companies, and it's bad for the legacy guys. And they're going to figure it out. But like, I think there was if you remember in oil back in 2014, like they were all fat and happy during the shale boom. And then we had the Saudis kind of take their legs out, and they got a lot more lean after that, right? They figure out how to run their operations a lot more lean because they had to. And I would imagine there'll be something like that will play out. Some of these will be fine. Some will, get loose, just how it normally is. But I think that's kind of one of the dynamics going on.
So Ben, look at NVIDIA. So Jensen, the pump master, the CEO of NVIDIA, he does conference after conference, press release after press release of billion-dollar deals. And the stock is unchanged since July. He's done everything possible through public events, through getting on with Jim Cramer, another conference this week. The pump master is losing his touch. Nobody cares. What's going on here? Nobody cares. Where are all the junkies? What happened to all these call buyers? They've all blown themselves up on NVIDIA calls.
The pump master, I like that. Did you term that? Is that your term? Pump master flex. I don't know. I mean, I just think it goes back to what I'm saying. This vol's up. The general market, like four horsemen, are not as constructive for leverage. I think there's a general sentiment has moved negative. So, when you don't see follow through on that, I think that tells you a lot about where the market's at. Now, look, if it was a turn, maybe the dynamic changes. But I'm pretty much thinking that like that's telling you something in itself, what you're talking through there.
Right. And credit, at first it was they told us that private credit risk was idiosyncratic through all those research reports. Then we saw a big move in the loan market where spreads on loans and CLOs started to weaken dramatically, the BKLN. And now you're seeing a contagion over to high yield, especially with Europe, because the European companies, Ben, are much more exposed to energy costs, right? Because of that big move in gas in Europe. It's going to wound a lot of Europe. So that you can see the underperformance of the crossover versus the U.S. So this is U.S. junk versus European junk. But that move in gas is going to wound a lot of companies that have to support themselves with energy in Europe. But once again, like you said, this is the four horsemen. There's a contagion from private credit over to high yield here.
Yeah, I mean, I think that's actually kind of an interesting dynamic that you talked about there. It's that the U.S., maybe that's why the S&P is holding up a little better, is the U.S., Russia and Brazil probably all set up where they can benefit from the situation much better than Europe, than Korea, than Japan, than China, who have, to import their energy. The Qatar LNG going offline, energy infrastructure going offline, like it hits them harder. And so I think that's probably right. But I would have to say you want to go below the surface to the sector level in there and see what the composition is, because I'm sure the industrials got hit a lot harder than maybe like the software. But I think that's the other thing on credit is, remember, software is now a real concern for a lot of these, like all that 2021, 2020 paper in software that Thomas Bravo and these guys wrote is a concern at this moment. So it's
right.
That would normally be an area that you'd be like, okay, energy spike, let's move into software. But it's a unique period.
And so for investors watching us, we always track new lows. We talk about this in our book, How to Listen to Market Speak. Top number 7 right now on Amazon, How to Listen to Market Speak. And when you see, Ben, the new lows trending higher, and you can see that bottom right here corner, in a bull market, a safe level, you should have a very low amount of new lows. But when the new lows trend higher every single day and then start building on a breakout, like today, we're going to probably have a big breakout here because this is as of yesterday. But it's a sign of massive breadth deterioration. All that means is there's just less stocks winning, more stocks losing.
Yeah, I wouldn't say that breath's very good. I have a model actually that built with an AI agent as dashboard. It's like we're like, yeah, pretty much bottom quartile for breath, on a like 5-year look back. So yeah, it's your Nvidia SMH stuff is holding things up. Your least favorite stock, Walmart, some of those staples have kind of until now with this rates things kind of hit that. So it's just like even yesterday, gold, Larry, right? Gold gets hit for 5%. That just shows you, hey, well, I don't know who sold it. Could just be a hedge fund, or it could be some Middle East guys, or Japan, or somebody who's like, oh, we need some money.
It's got to be it's got to be a funding vehicle, right? It has to be that kind of move.
Absolutely. Yeah. I mean, sending gold down 5 or 6% is an enormous move in gold. You know what I'm saying?
Yeah. And here's new lows on the Nasdaq. This is a better chart. Once again, healthy bull market. See those circles, those oval, those blues. In a normal bull market, that's where you want to be putting money at risk. You want to be buying breakouts when you have those new lows that are really contained. But when you have those new lows move up kind of sharply here, look at it, you got up near 300 this week and probably be over 400 in a couple of days from now. Next one, Jose. And so right now we're coming into the close. Yeah. So Ben, one of the things I'm really proud of the team. Our book is now in Korean. Both books are now published in 12 languages. We sold almost 1 million copies. Almost 1 million copies. Yeah.
Buddy. That's fantastic.
I tell my wife once a month, if we sell 1 million books, we'll break even on the Lehman stock, right? But Ben, anything in closing? Weekend here, a lot of people, Vol's getting pumped again because people are worried about something over the weekend. But I guess my big takeaway is that Trump wants an off ramp bad, and you watch, he'll try to flip it the way he did last. Remember last year they took Howard Lutnick, they put him in a closet and they locked the door, right? And then they put Vicente out. He did a great job on the Sunday talk shows, and they were able to do the off ramp. Now they do the same thing. We get a relief rally, but you're coming into real deterioration in credit. You're coming into like that latest move in energy, what it's going to do to the consumer, deterioration in artificial intelligence, job losses. So I think it's a lot different off ramp that we're going to see this time versus last year.
Yeah, I just think it's a two-way street. I think that Trump tariff thing was pretty much what he wanted to do, right? And it was unilateral. Whereas now, if the Iranians want to keep putting drones out, hitting infrastructure, and an asymmetric thing, it might persist. And I don't have any edge in saying what's going to happen or not happen. But what I would tell you is the market clearly is thinking what you're thinking, but that's why it's this slow bleed, because guys are very reticent to sell. But I think if we got something that was like a credible, kind of taco, off ramp, whatever you want to call it, I'm fading that, to be honest, this time. Like I tried to do that last year and I was wrong. But this time I'm thinking the underlying labor, the underlying credit, the lingering transmission mechanism effects of oil and gas and all the prices is going to put and the AI stuff. That's not going away. That had nothing to do with this war. This war was an accelerant on what was a weak underlying trend. That's what I leave people with.
Right. Yeah. So different off ramp 2025 versus 2026. That's one of the things that I'm getting up from clients.
Economy also weaker economy. Economy was much stronger last year than it is this year.
Right. Well, thank you. Yep.
I was just going to say, and I think the AI CapEx was still accelerating, moving up. Now we're kind of getting where it's going to be harder to incrementally outperform on that, right?
Yeah, that was really supporting GDP last year because the expectations of more and more. And then now you think about the one thing we didn't cover, the last thing I think in closing, but artificial intelligence data centers that look at Micron. Micron's just raping the hyperscalers, Mag 7 with memory costs boost, and then that and they're getting hit with energy costs and the cost to build the data centers, diesel costs, right? That's a lot of diesel to build the data centers and all the different, equipment that moves earth around and builds things, right? So your cost to build these data centers and the capex is even going to be, you're going to have big cost overruns, right? And so that's going to eventually work its way back into Mag 7 because they're the ones that are getting hit with this. But thanks, Ben. Have a great weekend, my friend. You gonna be on the West Coast this weekend?
No, I'm in the center of the country right now. I'll be back in California next week. Although I should have booked my flight earlier. I just went on. Flights have gone up. So
yeah. All right. Thanks, Jose and Valentina and the entire team in New York. Have a great weekend.
Thank you, Larry. Thank you, Ben, for joining us. And a happy birthday to Jose, our top producer here at the Red Shops Report. Okay, so as Larry mentioned, our book is back in the top 10 once again. And we're looking forward. I've been seeing some comments of people that haven't gotten their copy yet. So I don't know what you're waiting for. The link below, you can find it. And we are posted in Portuguese, Korean. The Vietnamese version is coming in. We have a lot of surprises ready for you. So perfect. Larry will be in New York City next week. If you're in town and you like to meet us, we're hosting events. So reach out to info@thebirdshopsreport.com and we'll be more than happy to host you. Again, as I always tell you, we always mention our turning point. We have a daily client chat recap, our Washington pressure points, which is our most recent report. That's basically one-stop shop for the Hill. We have built relationships over the past 15 years, and we want to give you that intel. So if you're interested in not only that, but our Discord chat, Bloomberg chat, or real-time trade alerts that are sent on WhatsApp, Bloomberg, or Discord, do not hesitate to contact info@thebirdshop